Assalamu alaikum. My name is Ahsan Kamran, ERP 21736, and my financial analysis is on Abbott Laboratories, Pakistan. Abbott is an American pharmaceutical MNC operating in Pakistan with a market share of 5.9%, producing these products. Looking at the internal ratio analysis, the first ratios we have are the profitability ratios, and this is a snapshot of the five ratios we'll be going over. So as you can clearly see, in the first 4 years, Abbott was financially very strong, with the averages shown here. The gross profit did not vary too much because cost of goods sold rose proportionately slower than net sales, as shown in the horizontal analysis, and PDA was the most profitable product. Operating costs were proportionately lesser, as seen in the vertical analysis, because of lesser research, workshops, conferences, etc. Lower tax rate and low interest rate led to increasing types of all profit. For example, net profit of 4.2 billion in 2017. Now, 2018 to 19 were financially weaker years since cost of goods sold rose because of SBP ordained inflation and currency devaluation. As such, exchange loss rose from 63 million to 380 million. However, despite this, the Drug Regulatory Authority of Pakistan, or DRAP, does not allow for price adjustment, which led to lower price profitability. And 2020, however, was a regained year because of higher sales due to COVID-19 and adjustment from DRAP and lower taxation rate. Now, looking at the return on assets and ROSHA, ROA averaged these values, but it fell considerably to 13.28% in 2018 and further in 2019. Increasing current assets were because of inventories in 2019, and fixed assets were because of property, plant equipment, because of microbiology labs, sterilization projects, etc. The ROA returned to normal in 2020 because of increase in net income, as previously stated. ROSHA averaged this value till 2018 due to varying EBIT and homogeneously increasing fixed assets, but it dropped to 9.72% in 2019 because of loss in EBIT, but again regained in 2020. Now, looking at the liquidity ratios, you can clearly see in this graph that Abbott's liquidity varied considerably. So it was 3.5 plus times in the early years, and it reached a maximum in 2016. But it has since been decreasing because of decreasing cash and bank balances because of lower profitability. So 2020 was the only exception with the highest cash figure for the entire period, and current liabilities are also rising homogenously. So the current ratio did not retreat to its early values, but this was perhaps a good thing because of better utilization of assets and financing. The quick ratio was also early on very high with around 3.3 times. It decreased in 2019. It increased in 2020, but again, it was not as much as before. So looking at the debt management ratios, these are the four debt management ratios, and debt to assets ratio is pretty much self-explanatory. It increased in almost every year with an average about 21.2 in the early years and a drop in 2016. So, however, in 2018, it boosted to 34 plus percent because of an acquired loan of 0.5% from Kybor in 2018, and with the introduction of gas payable in 2020. So these were the main rising components. Debt to equity, however, was inapplicable till 2017 because Abbott only considered its debt as being long-term lease liabilities, which including the Kuiper loan and the gas payable. So it increased to 4.02% in 2020. So looking at the long-term debt, it decreased homogenously till 2016 and increased from 2017. So I've already discussed more of this. So the long terms till 2017 were only deferred taxation, but 2018 saw the introduction of the Kybor rate and 2020 saw gas payable. So the tie ratio was also extremely high, starting at 1 to 48.03 times in 2013, and it's decreased homogenously till 2019, and it's still honestly very high. The excess income was not previously utilized properly, and because of currency devaluation and higher interest rate charges, the die ratio has fell. And as SBB explained, this is because of market expectations. So looking at the asset management ratios, this is a very quick overview, and as you can clearly see, I'll go over this quickly. Inventory ratios show strong inventory cycle management with about 80 to 90 days inventory turnover period, and a low was reached to 72.3 days in 2018 because of increased cost of goods sold, and this again retreated to normal because of increased inventories. The receivables ratio also shows strong cash collection, and the lowest was 8.27 days in 2015. This was much lower than its competitors. Recently, there's been some leniency on the trade credit policy, and looking at the payables ratio, Abbott generally has a very long DPO than its competitors, which shows that it pays its debts slowly, which is high enough to increase cash supply, but low enough to not aggravate its creditors. And there was a considerable increase in DPO, as you can clearly see here. So these two ratios are derived from DSI, DPO, and DSO. And this is not that important, but it just shows that Abbott's conversion cycle for its cash is much lower than its competitors, and it's much better than its competitors, and because of gradual decreases in adjustment and credit policy. So the turnover ratios have also been relatively stable. So the total asset turnover started with a high of 1.68 times, and the main reason for this was the high PPE because of new buildings, research facilities, etc. The fixed asset turnover has varied more because of the increased spending on PPE, such as liquid tablet manufacturing upgrades, serialization projects, barcoding, GMP compliance, etc. And the non-current assets have increased by relatively much larger margin than the current assets, which is why the fixed asset turnover has varied more, as seen in the graph previously. So looking at the market value ratios, you can clearly see that they've fluctuated a lot. So the PE ratio saw rapid fluctuation around 16 to 23 times, with 2019 being the highest because of low EPS. And the fluctuation may depict wavering investor confidence, which is the same case for MB ratio, which also fluctuated violently, reaching highs of 6.4 and 6.42 in 2014 and 2016 respectively, because of regulations by DRAP. The market price has been constantly decreasing. The dividend ratios have also been relatively profitable. So they started off relatively poorly for the dividends because of a DPS of only rupees 7. However, 2015 onward, the DPS increased, which is why the dividend yield also started to increase. However, it decreased in 2019 because of a lower DPS of 7.5. Similarly, the dividend cover relates DPS to EPS, and the DPS fluctuated between 1.0 to 1.16 times, but this increased rather drastically for 2018 to 19, again because of the low DPS. And the current DPS is high enough to retain investment and low enough to retain investor confidence. Now, the cash flow ratios also show a lot of variation, but 2019 is clearly the worst year. So the OCF margin has been generally healthy, but fluctuated massively, and because of the only negative value of CFO for minus 160 million. This is because of low profit before taxation and increased inventory. The cash flow coverage also mimics this movements, and this shows that total liabilities generally correspond to increase in net sales. And throughout 2013 to 2020, 2018 and 19 were the only varying years because of lower profitability, reaching the values as shown here. However, 2020 again saw regained cash coverage. The external financing index shows that Abbott relies mostly on internal financing because it's generally negative. However, 2019 was the only year where it reached a bizarre value of positive 24.37 times, which is very bad for Abbott. Asset efficiency also fluctuated along the earlier lines of OCF and CFC ratios. It's much higher than its competitors. So, for example, in 2020, Abbott had a asset efficiency of 32.7, whereas the industry average was 14.1. However, the ratio recuperated as shown here. Now, the newly learned concepts are these ratios, which are not in the course specified. The DuPont analysis has been showing Abbott's ROE has considerably improved. It decreased in 2018 and 19 because of lowered MPM, but it's reached its highest in 2020 because of the regained profitability. Now, the line items comparison, this is the breakdown of the comparison. The leftmost is Abbott and the rightmost is the industry average. And as you can clearly see, this is the breakdown of the composition of all the four main line items. So the total assets have Abbott's total assets are the third highest, but this is not necessarily a good thing for the competitors because, for example, Serco has a very low collection from sales, which is bad for them. So PBE was the most major composition, and the others are shown here as well. The higher cash bank balance due to has increased because of profitability, and industry average was much lower than Abbott, as shown here. The inventories were equivalent to stock in trade, and they comprise about 31.7% of current assets, and their values are given here as well. This leads to a quick ratio of 1.29 times in 2020, which was much higher than most of its competitors, except for High Noon, which is not always a good thing for them. Finally, coming to net income and net cash flow, net income was generally much higher in the sector because of medicinal sales because of COVID-19 and because DRAP allows slight adjustment. Abbott had the highest net income of 4.53 billion. The second highest was GSK, and the lowest were these values, which shows a considerable gap. Abbott also had the highest net cash flow because of the aforementioned profitability and because of lowered inventories. And this was partially offset by the slightly high CFI because of fixed capital expenditure and the higher CFF because of high dividends because of DPS of an insane 440 rupees and because the lease rentals were acquired. These are some concluding takeaways about Abbott. It shows high profitability except for 2018 and 19 because of currency devaluation, strong liquidity standing, especially since 2017, but 2019 saw too much inventory accumulation, strong asset management, strong debt management, and it's starting to leverage its firm now. Stocks are generally fairly valued, but investor confidence is wavering. There's strong cash inflow except for 2019, which saw CFO and ratios become negative. And finally, stronger standing than competitors. GSK was the closest, but even that shows a massive gap between the two. That was my presentation. Thank you so much for listening. I hope you enjoyed it. Allah Hafiz.